On a Saturday in late February, U.S. and Israeli forces launched joint airstrikes across Iran, killing the country's supreme leader. Within hours, retaliatory missile barrages were firing across the Middle East. Global financial markets reacted immediately. The Dow Jones Industrial Average dropped 400 points in early trading, and Brent crude oil spiked 8%, surging past $85 a barrel. The anxiety in the energy sector traces back to a specific geographic bottleneck, the Strait of Hormuz. Roughly 20% of traded oil passes through this narrow waterway. With military forces exchanging fire, commercial shipping traffic ground to a standstill. In our globalized economy, physical violence in a key transit hub instantly severs international supply chains. Investors see that physical disruption and immediately begin selling off assets to limit their exposure. But the initial market crash is rarely driven by facts alone. It gets heavily amplified by a secondary shockwave, the weaponization of social media. During the first weekend of the conflict, unverified claims went viral, asserting that Israel's Iron Dome, their primary air defense system, had completely failed. Posts featuring apocalyptic imagery and inflated casualty numbers flood the internet. High-frequency trading algorithms scrape the sentiment data, and retail investors see the panic online. Both groups react by dumping stocks. You can track this panic through the VIX. The VIX is an index that measures the stock market's expectation of volatility based on S&P 500 options, often called the fear gauge. As the VIX spiked, traders rushed into safe haven assets, pumping the price of gold well past $2,300 an ounce. Psychological panic and digital disinformation dictate market movements during the first 48 hours of a conflict, causing prices to decouple from actual economic exposure. Once the initial dust settles, institutional capital stops fleeing and starts reallocating. Smart money begins aggressively picking sector winners and losers. The immediate financial beneficiaries are obvious. U.S. defense contractors like Lockheed Martin and RTX saw surging buying volume, pushing stock prices to all-time highs. While defense stocks rallied, the Asian semiconductor market experienced catastrophic bleeding. The crash exposes a hidden vulnerability. Microchip manufacturing relies heavily on highly specific raw materials sourced from the Middle East. The threat to that regional supply chain wiped $200 billion off the combined market value of tech giants like Samsung and SK Hynix. War triggers a violent reallocation of global capital, draining liquidity from supply chain-dependent tech sectors and funneling it into defense manufacturing and commodities. Amidst the chaos, a major global macroeconomic anomaly emerged. While European and Asian markets continued to spiral downward, U.S. equities steadied and began to recover. Based on J.P. Morgan data, massive oil volumes flow from the Middle East to Europe and China. In contrast, North America is a self-contained loop. Unlike the vulnerable 1970s, today the U.S. is a net oil exporter, relying primarily on Canada and Mexico. That creates a massive global economic divergence. Europe and Asia face an existential supply risk. They could literally run out of fuel. The U.S. only faces a price risk, meaning Americans might pay a few more dollars at the gas pump. By securing its own energy production, the United States built a structural macroeconomic shield. That independence largely insulates American equity markets from the physical realities of a Middle Eastern blockade. When headlines are dominated by war, the natural instinct for retail investors is to liquidate their portfolios and hold cash. But history suggests that is a mathematical mistake. This visualizes an LPL research study analyzing the S&P 500 across 26 major geopolitical shocks since World War II. During these conflicts, the broader market historically pulls back an average of just 4.5%, stabilizing and recovering in less than a month. Wall Street traders operate on the adage that stocks take the elevator down but the escalator up. This sudden drop reflects immediate uncertainty, while the steady climb reflects the economy absorbing the new reality. The data is clear. Liquidating assets during the initial fog of war guarantees a loss of capital during the recovery phase. Panic selling is driven entirely by human emotion, not statistical precedent. Sustained inflation represents a far more persistent threat to the U.S. economy than the immediate physical conflict. If geopolitical tensions keep the price of crude oil permanently above $100 a barrel, transportation and manufacturing costs skyrocket. Those elevated fuel costs act as a hidden, compounding tax on every consumer and business in the country. An energy-driven inflation spike creates a massive problem for the Federal Reserve. To keep prices from spiraling, the central bank is forced to pause any planned interest rate cuts, keeping borrowing costs punishingly high for corporations. Institutional investors are not tearing up their portfolios to survive a regional war. They are adjusting their allocations to survive a prolonged high-rate, high-inflation environment. The geopolitical map of the Middle East is actively being rewritten, but institutional capital survives by tuning out the violent noise of the daily news cycle and anchoring strictly to the underlying economic fundamentals.